Good afternoon, everyone. Welcome to today's market stream. My name is Stock Darts, and we're going to cover the markets like we do every Wednesday. We're going to go ahead and take a look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the markets, we'll take a quick look at the U.S. dollar. We'll look at gold, silver, oil, just see how commodities are behaving, see how the dollar's doing, and then we'll take a look at some chart requests. If anyone in here has a request, feel free to add it to the chat, and we'll take a look at it. And I'll see whatever it is that the chart is, whether you need to look at it as a possible entry, or maybe it's a stock you're in and you're just trying to figure out whether you want to get out of it, or whether you should be looking at taking profits, or even if you just have a question on a pattern on it. Hey, Fat Boys, welcome. Glad you made it today to the right video. If you guys like what you see here, you can always follow me on Twitter at Stock Darts. You can find my videos at YouTube on Stock Darts, or you can visit me at patreon.com/StockDarts, where we post weekly blog content. I typically will put trading ideas, watch list ideas, the ideas that we discuss over these Wednesday webinars, or these Wednesday market reviews. A lot of times you may wonder how I implement these strategies and how I go ahead and attack the types of markets that we evaluate, and usually that's the kind of stuff that I put on my Patreon page. So if you're interested in that sort of stuff, feel free to put it on there. As you can see, by the way, Fat Boys, sometimes my Twitter messages come in a little late with the app that I use, so sometimes I'm a little slow in responding, but I usually respond once I get those. But anyway, let's go ahead and get started. I see you want to look at gold, Barrick Gold, so we'll take a look at that probably when we get to the gold and silver portion of today's stream. All right, so first thing we're going to do is look at the S&P 500, and we've been in an interesting place these last 3 or 4 days. The market's been a bit of a roller coaster. Matter of fact, for those of you that are Patreon subscribers, that was the image that I used to describe the market this Monday was a roller coaster, where we've been just kind of sort of switching mentality from day to day, and it's been really difficult to get a good gauge on what the market wants to do. If we kind of scroll back, I'm going to zoom in a little bit for this part, because we only need to look at the last few days. And we take a look. This is kind of where we stood. I believe this was last Wednesday, July 8th. Yeah, so last Wednesday, we had a market that had just broken out and was looking, it had a nice bullish look to it as it started to flag after breaking a nice descending downtrend and started making its way back up to the top of a short-term range, right? So things were looking pretty strong and looking pretty positive for it. And then if you notice, the next day we had a hammer candle. Usually you don't want to see hammer candles towards the top of a range, but either way, we still finished strong. Things were looking okay. And as we close Friday, you can see it was a very bullish candle, right? We had it's closing at the very top of the range, and everything looked like it was going to be a bullish start to the week, and just a move looking to close this gap and start challenging highs, right? And then what happened on Monday was we had a really strong move, and the first part of Monday actually looked like a really bullish candle. It looked like the market was ready to start challenging highs, but we faded the entire time and closed at the bottom, which was a pretty decent reversal signal. We had a lot of, you'll see when we get to the Qs, what looked like a topping candle, and so we had a change, right? So on Friday, the market looked like it wants to go up, and then on Monday, all of a sudden the market looks like it wants to go down. And then yesterday, we had a bullish piercing candle showing the market's not ready to drop, and made a big strong move right back towards close to recent highs. And then that's where we stand today. What ends up happening, we gap up towards that level, and immediately we find selling pressure. So I think what it shows more than anything is that right now the area that we're at is a pretty big battleground between buyers and sellers, between the bulls and the bears, and the market is really struggling to figure out where it wants to go next. Typically, you don't want to see this. You can see volatility starting to increase, but price is not going anywhere. And typically what you want is, if you're a bull in particular, you want volatility to increase as price goes up. You don't want volatility to increase as price goes sideways. And yeah, in the short term, you could say, well, price is going up, right? Because technically speaking, we are kind of making new highs. But generally, we're really, if you look at it in the intermediate time frame or even the long-term time frame, we're still going sideways on everything but the NASDAQ. And you can see volatility increasing as we try to really figure out where we want to go next. We already had a nice volatility increase in the middle of June and July, or start of July, as we kind of broke down from this level of resistance that we're trying to challenge again. And each time we've come up to this level around 320, we've been quickly rejected and start to make our way back down. Now today we're holding up a little bit better than we did on Monday, but we still have a few hours to go into the close, and we'll see how that responds. And so, I've noticed a lot of different opinions on my Twitter feed and on my social media accounts. Some people very opinionated that this market is going up, and that people that are bearish have no cause for it. And then the opposite as well. People that are bearish that think the people that are long are getting a little too complacent in their trust in this market. And my opinion is kind of in the middle, right? I feel like this market is getting heavy. I feel like this market is due for a pullback. However, the price action has not completely given us the impression that we're ready to drop. Because each time that we drop, we find immediate support and we make our way right back to highs. And so I'm kind of in the middle of this. I feel like we are, like I said, these last 2 or 3 weeks, we're not in an easy market to trade right now. We're in a market that is very difficult to really get a gauge on, because as you can see, every 2 or 3 days the scenario shifts, right? We had a nice move up, and then this is when we had the change in character, right? On June 11th, when we had the big drop after trying to make our way past 320. And then you'll notice the character of this market has changed pretty quickly every 2 or 3 days. We had a very bearish 2 days, and then we had a very bullish 2 days. And then we had a nice kind of easy move for a few days, and then we dropped. And then right away the change in character, we made our move right back up to highs. And then as you saw earlier when we reviewed it, these last 2 or 3 days we've had pretty big shifts in character from day to day. Now, in the bigger scheme of things, we're really just chopping back and forth in a range, and that's something that traders need to understand. This happens a lot when you trade in a range, right? So if we go ahead and we take our little rectangle tool and we go ahead and point out what's going on here, we're just trading sideways, right? We're just challenging 320, maybe a little bit above it, maybe the 322, 323 is the high. But we're basically just challenging that area, and we have very nice support down here at 300, and we're just going back and forth between that range. The last couple of weeks, it was really just this range between about 315 and 300, but it's the same general idea. We're really just kind of challenging these highs that we printed before and establishing what the lows are. And so there's enough ammunition here for bulls or bears to be happy with what the price action is doing. The bulls are happy that we've been able to maintain support. We haven't had any kind of a reversal in price action, despite the fact that we've encountered strong resistance. And the bears are happy because we finally stopped climbing and we're trading sideways. And in their mind, it's only a matter of time before we roll right back over. Now, if I had to give one side a little bit more credit than the other, I'd say the bulls are still in control of this market. We did have this nice move. Then when we had this consolidation, we broke the downtrend and made our way right back to the top of the range. So in order for the bears to have control and to say that this market is still in the process of rolling over, they're going to need to at the very least start pushing the moving average, or the price action back through the moving averages and down to the low 300s. And at the moment, that's not the case. Matter of fact, we're getting what many technical traders consider the quote-unquote golden cross, which is when the 50-pair moving average crosses the 200. This is often a good sign of an emerging long trend. We have the 20, again, starting to curl up with the 50 just beneath it, both kind of making their way upwards, which is usually a sign of a trend as well. So I'd say overall this is still bullish more than it is bearish. However, I still don't think the risk-reward is great at this point. And I think going long too strongly at this point is not a good idea. I have long-term holdings. I'm not adding anything right now. Swing trading is a different story altogether. Those of you that follow me on Patreon know that we looked at long trades this Monday because we expected a week, at least the first half of the week, to be bullish, if not the entire week. And those trades are finally starting to gain some traction today, and we'll take a closer look at them a little bit later. But I still think the idea right now is long trades are working better than short trades, but as we hit these levels of resistance, we have to keep an eye out and be ready to turn around and take some short trades if we falter and start to really find some more selling pressure as we hit these levels. However, one thing I'm very keen on right now is I don't want to take any long or chase any long trades at breakout points, right? So I don't want to be chasing longs at highs. I'm looking at trading any kind of longs that I'm trying to initiate. I'm trading at support, looking at stocks that are breaking out from descending trends, much like what happened here at the end of June in the S&P 500. I'm not looking to take a breakout trades like what the S&P tried to do today, as it tried to break past the last 2 days price action at the top of the range. To me, that right now is probably a dangerous game to play because of the fact that we're still in a range, and when you're range bound like this, you don't want to really you don't want to go long at the top of the range, and you don't want to go short at the bottom of the range. And until we establish a new range, you have to go ahead and kind of keep treating the market the same way. One other thing to point out before we get into too much more detail with the markets is we did start a new earnings cycle this week. We have a lot of earnings reports that are going to start coming out over the next couple of weeks. We had some banks report over the last few days, and with a sort of mixed results so far. We have Netflix reporting tomorrow, and then in the next couple of weeks, we'll start to get some of the big names like Apple, Amazon, Google, and I think they'll probably have more say on where this market wants to go next, as opposed to what's happening right now. But we'll wait and see. We also had some bullish news flow from the biotech sector, with Moderna having another positive result from their early vaccine trials. And that kind of helped the market overnight, and we'll see whether that's enough good news to really push it further in the face of what continues to be extended shutdowns in a lot of states as they start to close up some of the areas that they opened up over the last couple of months. So I think news overall is still kind of a mixed bag, and with the stock market now entering another earnings season, we'll have to wait and see what the earnings are, especially what the guidance issued over the next few months is, as far as what these companies expect to do, and then we'll see what the market wants to do next. But like I said, we're in a pretty big battleground right now, and I think it's a difficult tell to really figure out where we want to go next, and that's one of the reasons that I've been kind of saying right now we want to be more cautious about our trades, and we don't want to really try to push the envelope too much. Now, if we look at it overall, it's still been pretty bullish, right? We had the big crash in February and March, and if you notice, we almost have like a really nice cup and handle going, right? You've got this nice drop, and we've kind of recovered from it, and right now we're just kind of trending sideways as we build up momentum to try to push back through it. So in a lot of respects, the market is giving us signs that it has already, that it's kind of recovering pretty well, and trying to set up the stage for a move right back towards where it was before this whole pandemic started. Now, whether we think that the market should be here or not, that's not for us to decide. Despite the fact that our economy has taken a big hit, there is a lot of stimulus being pumped into the markets through the Fed, and that can often negate what we consider to be a poor economy, because there's still money being flown. There's money flowing in and capital flowing in that needs to go to stocks, and so for the moment, the market is still holding up well, and it still looks like it wants to start making a push. Now, that being said, the risk reward's still not good. Let's say we do resolve from this in a bullish manner. There's still not that much upside before we find, even more overhead resistance is going to be even stronger than where we are right now. So ideally, really, if you want to go long this market, you probably want us to come back down and start trading sideways a bit longer. You don't really want to go long here looking for a move of maybe 10 points when the downside is at least 20 points and possibly even further, depending on the nature of price action over the coming months. So for now, like I said, let's be careful, and let's try to make sure that we take advantage of where money is rotating. I've mentioned over the last month or so that we're in a stock pickers market right now. Individual stocks are giving us different types of patterns, and not everything is highly correlated with what the market's doing. And as we go through earnings season, that's going to be the case as well. For those of you that may be worried about this market and you don't want to go long as this market is pushing up towards levels of resistance that you don't trust, well, when we have earnings season, every name that reports earnings, that move is not correlated with the market very well. So if you want to look at names that you want to trade, maybe look at whatever just reported earnings, and then for the next few days, or the next week or so, they're likely going to move out of their own volition rather than just following whatever the market does. So it's a good time to look around and keep an eye on what's moving back and forth, because there are going to be different areas that move as we kind of move forward and start to see what these different types of industries are doing. And a lot of times, a lot of related names report earnings pretty close to each other, so it makes it a little bit easier to kind of gauge what's going on between them. So like banks will report all together, a lot of airlines will report together, and then of course a lot of internet companies or tech names will report together. And so you kind of get a good idea of what's going on from industry to industry, and that gives you a way to kind of go ahead and see where money's flowing in or out of, and take advantage of those trades, even if the market just churns sideways and continues to kind of oscillate back and forth from day to day without trying to really go anywhere in particular. All right, so let's take a look at the key levels on the S&P 500 and try to really figure out where we want to go next. So, as you can imagine, we're at very strong levels of resistance here around 320. We filled that gap from that moment that we dropped in the middle of June, and we're really trying to approach or challenge the recent highs right around 323, 324. And if we can push past that, well, then we have a gap here around 332, which is 10 to 12 points away, and that will be the next level that we need to concern ourselves with if this market continues upwards. Now, I will say this: if we fill this gap around 332, there's a very good chance that the market will attempt to push to new all-time highs, and that would be a pretty bullish move. So if we can get past 330, 322, 323, then expect probably a challenge of all-time highs at some point in the next couple of weeks. Now, if we falter again today, and we end up closing at the lows and maybe even start to make some headway into yesterday's candle, then probably more likely than not, we're going to make our way back to the moving averages, and we'll have to see whether the 20 can continue to support price action. If it does, then we'll just keep going back and forth for the next few days and try to figure out whether we have enough to try it again. If not, then we'll make our way back to the 50 and the 200, and then we'll see whether support is there in order to hold price action at the bottom of the range. Overall, like I said, we've got a lot of room to drop before we have to worry about a bearish turn of events. We need to lose 300 to 299 before we really have to worry, and even then we have a nice strong level of support just below it around 295, and that's a long-term level. If we go ahead and look at the weekly chart, you can see that 295 is actually very important, because it's a level that has held us. It was resistance for a couple of years and has now turned into strong support. So there's a lot of support down here, and for those that are worried about this market and think that we are close to another top coming and another drop, there's a lot of support underneath us. And even if we do start to find more selling pressure, there are levels here that bulls are going to defend staunchly. And so at the moment, I'm not worried if we drop. I think if we drop, it's probably a good thing, because it gives us a chance to buy some dips and to get names as they head down to levels of support. Even if we lose 295, there's another strong level of support just beneath it that could also hold. And really, I would imagine if we do end up topping out over the next couple of weeks, more than anything, I think it signifies a market that's going to continue to stay range bound rather than a market that's going to have a second crash like what we saw in March. I think that's probably in the rearview mirror. I don't expect the market to react in quite the same way that we did in March and February, March, and even the beginning of April. I think we're at a point now where if we do have too much selling pressure to keep going upwards, we're just going to continue to trade sideways. Maybe head down a little bit, but not really end up with the same sort of move down that we saw in March and February. So, that's kind of where we stand now. Support levels, like I said, we've got 299 to about 295. From here to next Wednesday, we more likely than not will sort of stay somewhere above the 50-pair moving average or the 200. Now, upside, it's a little bit more difficult to tell because we're so close to breaking through it. Like I said, if we break through it, we'll fill the gap. If we don't break through it, then we'll probably just continue to chop somewhere around these moving averages until we get bigger names to report earnings. All right, so now if we look at the NASDAQ, we'll see a bit of a different picture, of course. The NASDAQ is already in full-fledged breakout mode. We had a breakout in June while the rest of the market was still struggling. Came back, retested it, and then you'll notice we've just been bouncing our way upwards, right? We come back, hit the 20-pair moving average like a trampoline and make our way upwards. We came down Didn't even reach the 20. Like a trampoline, we bounced these last couple of days. Now, yesterday's candle, or not yesterday, but the day before, Monday's candle was actually a pretty bearish one on the Nasdaq. Right? You can see that was a pretty big bearish engulfing candle. Took out 2 days of price action off of a really nice gap higher, and that's typically a reversal candle. And the fact that we've made our way back up is, while it's nice, I don't think is enough to negate that candle yet. And so this is probably the biggest warning sign that the market needs to sort of stall out and make its way back down was yesterday's candle. But one candle is often not enough, right? You look at what happened here. We had the same sort of candle on June 11th, right? We had a nice rising wedge, and we had a reversal candle that came in and took out the previous highs and took out actually 4 days or 3 days of price action, 4 if you count the gap above it. And what ended up happening was it just took 2 days to find new buyers, and then we just kind of made our way back upwards. So we have the same sort of distribution candle, showing that there was a lot of sellers waiting to take control of the price action, but buyers have come in right away, right? And so as long as they continue to negate these bearish candles, we have to kind of trust in the price action and keep following it upwards. But like I said, you don't want to be the guy chasing the price action, right? You want to be the one that's buying the dips. You want to be the one that's taking advantage of good risk reward, because in these types of markets, trades are going to be wrong more often than in good markets. So you want a trade that when it's wrong, you lose maybe 1 point, and when it's right, you get 5 points. That way, if you lose half your trades, you're still making a good amount of money. And so that's what we're looking for right now, and that's how we want to go ahead and trade these markets. Now, as far as the Nasdaq is concerned, I think again it shows that tech is still the best place to be. The big tech names are still fairly well insulated from what's been going on with the coronavirus shutdown. And I think at this point it's more profit taking, especially as we head into earnings. If you take a look at some of the big names, some of the real high flying tech names, you'll notice that they are forming similar patterns to the Nasdaq, right? You look at Amazon over the last 3 days, it started to kind of sell off a bit. Still holding up pretty well, but you can see that it's starting to lose some pressure. Tesla was another one. Tesla's been very explosive, and over the last few days, it's finally seen some selling pressure, but overall still holding up pretty well, and still kind of maintaining this upwards bias. But you can see that we're starting to see some selling pressure in some of these big names. And like I said, I think at the moment it's probably due to some profit taking, because they had very strong moves up into these levels of distribution or some selling. All right, so let's go back to the Qs. So key price levels, right? Obviously, resistance is Monday's candle, right? That's all we have. Anybody that bought the Qs, if they didn't buy it on Monday, they're probably up, right? It's just a very strong move up. Really, at this point, we have a very short-term level of support. Right around 255. I wouldn't consider this major support, but this is something that's starting to develop, and it's important to keep an eye on. 20-pair moving average coming up to meet price. If we drop over the next couple of days, it's going to be very likely that the 20 and this level of 255 converge at the same time and offer support again. If we lose the 20, then we'll come down and test the 50, and we'll chop back and forth and likely continue upwards. But until it loses the 20, we have to assume the Nasdaq is in a nice uptrend and will continue to make its way upwards. So if you're looking at the Nasdaq and you're trying to figure out where support is, I think right now this brown moving average, the 20-pair moving average, is the level of support you need to consider. And horizontal supports are secondary, but it looks like these two will converge together and likely offer a good buy the dip opportunity on the Nasdaq. Now again, if it fails, which there's a decent chance depending on how the markets behave over the next few days, then it will likely make its way back to the 50-pair moving average. Long term, this 237 is now very strong support, and I think with the Qs, this will be the level, this will kind of be the line in the sand, where as long as we're above this, there's really nothing to worry about with the Nasdaq. Even if we have very strong selling over the next week and we lose the 20-pair moving average, as long as we hold above 237, then we're still in a breakout, and we're still above all-time highs from earlier this year. So overall, still the strongest index, still the strongest area in the stock market, and still really the area you want to focus on if you're looking to trade to the long side, particularly long term. If you're looking for long-term holdings, you still want some of these names. Now, you don't want to buy them at highs. You want to wait for them to correct, but you still want to be looking at these names as they hit support levels rather than trying to get out of them. Um, I'd say we don't have to worry about anything below 237 from here to next Wednesday. So it doesn't really make it. It doesn't really mean much for us to go ahead and analyze it. Next level down would probably be somewhere in this gap around the 225 area. But more likely than not, we're not going to see price action below 237 from here to next Wednesday. If we do, then there's been a major shift in the market. And with a lot of the big tech names reporting, in about 2 weeks, it's very likely that there's not enough news flow to really push the market, to push the Qs through these two moving averages that quickly. All right, we look at the Dow Jones. We'll see a picture similar to the S&P 500. Obviously not nearly as bullish as the Qs. We just filled this gap here from June 11th or June 10th, and we're not near our recent highs yet. So relatively speaking, the Dow Jones is still kind of lagging behind the S&P 500 and certainly behind the Nasdaq. Overall, it's still kind of a bullish move, right? We still had this descending trend line. We still broke above it. We came back. We retested the breakout, and we've kind of made our way upwards and back through it, right? So overall, this is still a bullish move. Just making our way to the top of the range, and then we'll see how price action reacts as it hits the top of the range. So you'll notice with the Dow Jones, there's still a little bit of room. There's still a little bit of upside before we really hit major levels of resistance. However, with the other indices kind of starting to stall out, the Dow Jones is also slowly starting to taper off a bit as it hits the 270 to 275 range. A lot of the analysis of the S&P 500, I think, holds for the Dow Jones as well. If we can break through this 276, then we're likely going to go ahead and come up and start challenging some of these levels from earlier in the year. Now, you'll notice that we probably don't fill the gap on the Dow. We probably come to the bottom of that gap around 283 and challenge this red line, which was a kind of an important area. It was the last level of support before we really broke down in February. And that's kind of the area we need to go ahead and challenge. Now, we did have a pretty bullish development this week with the Dow, which was it made its way back above this 265, which again is a pretty critical long-term level, right? It's a long-term resistance level. You'll notice the range that we spent the last couple of years in 2018 and almost all of 2019. That 265 was kind of a critical area. And you'll notice what we're doing now is we're making our way back towards the price action of the latter half of last year, or the latter portion of last year, before we really broke out into the holidays. And what we're doing right now is trying to make our way back up and challenge this 273, 274, and hold above 265. And I think if we do that, then again, that's another bullish turn of events. And it shows again a market that is starting to kind of shrug off the coronavirus, despite the fact that, looking at the news, you would think that we're still dealing with, and we kind of are, our economy is still dealing with it pretty well, but the market is starting to look past it already. And unless we start to see a shift in character, we have to kind of assume that the market wants to keep pushing through it. Now, there's always the chance, or there's always the possibility that we will eventually roll right back over and lose 265 on this, and lose those the key levels on the S&P 500 and the Nasdaq, and make our way back into the range that we spent 2018, 2019 in. However, until it does that, we have to assume the market is ready to push past it. If it does, well, we have our warning signals. We know exactly where the market is looking at to gauge its price action compared to where we were the last couple of years. So we have warning signals that we can keep in mind. If we see these indices lose these price levels, then we know the market is starting to lose faith in our economy. Until it does, we have to kind of trade with the assumption that the market knows more than we do, and that's why it wants to continue to make its way back up towards those price levels that we had earlier this year. Okay, so that's kind of where we stand with the Dow. If we drop, you'll notice we have the 200, the 20, and the 50, all within, what is this, about 7 points of, right, from 255 or so to about 262. So all the moving averages are pretty close together. All of them are going to offer possible support if we do kind of pull back. So even if we drop over the next couple of days, there's good support here to give us the notion that the Dow Jones can still kind of make its way upwards and stair step upwards. So more than anything, I think it shows again we have good support beneath us. So even if we do get rejected again at these price levels, there's a pretty decent chance the bulls are going to come in and try to support the price action. Um, so those that are bearish, I think you need to be a little bit more patient or wait for another big red candle before we really start to get excited about the bulls losing control. I think at the moment the bulls are the ones that are in control, and even if we drop, they're likely going to support price action. We've kind of gone over it, but again, the critical level here is basically 250 to just below 247. As long as we hold above that, it's a bullish move. Chances are that the moving averages support price action before we get to that. And to the upside, 275 is critical. I don't think we push through that right away. If we do, we likely get rejected at 283. So upside is still kind of limited at the moment. So we have to kind of be careful about how we go ahead and try to trade any of these stocks. And then finally, we have IWM. You'll notice IWM actually up very nicely today, 3%, right? You notice S&P 500, 0.6, 0.3 down for the Qs, 0.6 up for the Dow, so very similar to the S&P 500. And then IWM today getting a nice push upwards, right? So money flowing to what it thinks can give it its best return. Like I said before, at the moment, if you're trading, you want to follow where the money's flowing. What happens, and this has happened actually maybe 2 or 3 times over the last 2 or 3 months, where when these high-flying tech names get tired, we have little surges upwards in some of the weaker names and some of the small cap names. And that's kind of what we're seeing these last few days, right? I don't know if JB is in here. He was in our Discord, but he was talking about going long some cruise lines. And they're up pretty nicely today. You'll notice NCLH, which is the one we were talking about, it's up 16% today, right? Not a major move if you look at the chart, but it's still a very nice percentage up. And there's a lot of weaker names that are bouncing today because money is flowing to them because they're at very important levels of support that if they lose will turn into another big downtrend. And as a matter of fact, with this one, it actually is still kind of struggling with that downtrend. But very nice move today, broke through the moving averages, and I think that's kind of the case. You'll notice Carnival, of course, another cruise line with a big percentage move up as well. But a lot of these weaker names are moving up today, and I think the reason for it is money's flowing to them because they're flowing out of a lot of those big tech names. And that's kind of one of the things you have to keep an eye out for when you are trading is understanding this ebb and flow and where money comes in and out of as we go back and forth through different industries in the stock market. And so, small caps right now doing well. Overall, still by far the weakest group. And I would say today's move up is not enough to go ahead and say get aggressive to the long side on small caps. It's more along the lines of understanding when you want to take your shots with quick trades. Because again, if you take a look at the long-term chart, you see where IWM is compared to where it's been before, especially when you compare it to what the other 3 indices are doing. You'll notice we're nowhere near all-time highs. We're nowhere near even recent highs. And as a matter of fact, we're still trying to push through the range that we spent the last couple of years in, which again which was already lagging behind what the other indices were doing. So overall, still by far the weakest of the 4 indices. Still trying to contend with the 200-period moving average. However, despite all that, it is bullish what we're doing, at least relatively speaking. We were able to kind of break that same downtrend the other indices did, came back, retested it, and made our move upwards, and are going ahead and trying to challenge recent highs in order to make our way back towards the bottom of that range that we spent the very good, the nicest part of the year in before we had, we entered the coronavirus panic and drop, right? So we're making our way back towards this red line, which is pretty critical. Still quite a ways away. And honestly, if there's one index that's not going to make it there, even if we have a nice bullish rally, it's going to be IWM. IWM, I think, is still contending with some pretty critical levels here around 152, 153. That was a pretty critical level back in March. It was an important level now in June, and it will likely be an important level in July and possibly even further moving forward. So um, that's kind of where we stand with with IWM. I think again, if you are bearish this market or you're looking for a negative change in the market, IWM is still the first one you want to watch, right? You want to see if IWM loses its moving averages and loses, more importantly, this 136 level, which would be a very important drop of support, and likely will mean a quick move back down to the 120s if that were to occur. So I still think if you're looking for bullish signs, the NASDAQ is still probably where you want to look. If you're looking for bearish signs, IWM is probably what you want to look for, and you want to see whether we lose support on those. Now, if we do lose support on IWM, it doesn't necessarily mean it's going to drag the entire market down with it. It hasn't really done that for a while, but it will show you that, again, money is still pretty cautious and still scared. So at the very least, it means that we're going to trade sideways until we can get a better grip on where the market wants to go next. So that's the four major markets. Like I said, I think we're entering a new earnings season. The market is still kind of in a weird place where it's trying to figure out where it wants to go next. So far, the action is bullish, but we are seeing signs of selling pressure coming in every now and then to put a dent in the market. So there's more and more bears showing up to the party. Not enough right now to outnumber the bulls, which is why we keep kind of bouncing and keep pushing up towards support. But we'll see as we start to hit some of these levels just above us whether more bears come in and eventually outnumber the bulls. Until then, we have to go with the status quo and keep trading more to the long side than the short side. But more than anything, I think, again, just be patient and buy support and sell resistance. Don't try to buy at the highs and don't try to sell at the lows. I think that's a recipe for disaster with a market that's going back and forth like it is right now. Okay, let's take a quick look at the U.S. dollar. We'll look at gold, silver, and oil, and then we'll take a look at any charts you guys want me to look at. Anyone else that's in here, we have 5 people in right now. Those either are here, if you want, feel free to type it into the chat. Just tell me whatever chart you want to look at. You can, it doesn't have to be a chart you want to go long. It could be, of course, but it could be something you already own and you don't know whether it's at support or resistance, or maybe you even just have a question on a pattern. Whether it's a pattern I just discussed or a different pattern that you're looking at, trying to figure out if something is a double top or bottom or whatever. More than happy to go ahead and answer those questions and just kind of get any nice dialogue going between us. All right, so UUP, pretty bearish. The dollar has been struggling. Nice move down. Now you'll notice we're back at support here, and there's a decent chance here that we find some stability and a little bit of strength coming for the U.S. dollar. Doesn't look like it, but considering that it's been range bound, we're right back to the bottom of that range. There's a small chance here we try to bottom out and make our way back up, and then from there try to stabilize and at least go back to sideways. You'll notice, if we look at the individual crosses, and okay, so remember with this one, the euro, up is good for the euro in this chart, right? So the euro is making good headway versus the U.S. dollar, but you can see it's starting to, find some selling pressure here. It's right back to highs. I think this is a good portion or good spot here for anyone that's long the euro to take profits and to wait. And I think at this point the U.S. dollar is probably going to find a little bit of strength and at least cause the euro to stall out. However, overall this is still pretty bullish right now for the euro. If we look at it long term, we'll get a better idea of where we stand, and you'll note that we are trying to break out of a pretty important level. Matter of fact, I think if we go to monthly, we'll get a better picture of it. So you can see that was a pretty critical level from 2015 all the way to 2017 or so. 114 was a pretty important level. And we kind of broke down below that level this year, and we're right back to the top of that range. I think that this is a good spot, like I said, for the euro to stall out, because again, it's a pretty major long-term level. And if that's the case, then we will see the U.S. dollar kind of gain a little bit of strength, and maybe make its way back down to the 113, 112. Now, because we're at a price level doesn't mean that you just go ahead and turn around and take the opposite side of that trade. You still want to see price action confirmed that move, and today's candle's not enough yet. But we'll see whether eventually the U.S. dollar gains traction and starts to push and give us a little bit of pushback versus the euro. But for now, the euro is still kind of pushing upwards as it engages with this level of resistance and tries to push through it. Now, if we look at the U.S. versus the Canadian, again, this one again, up is good for the U.S. dollar now. You'll notice the U.S. dollar struggling versus the Canadian. However, it is starting to trade sideways. It is finding some support despite the fact that it was rejected pretty swiftly again today. And really, it's just trying to stabilize here. It had a nice strong move versus the Canadian, especially when oil was really struggling. And now, as oil has started to regain value, the U.S. dollar has kind of lost traction and has continued to drift downwards. However, oil has reached the point where it's starting to stall out as it finds levels of price that it probably isn't ready to push through. And with that, the U.S. dollar should gain traction versus the Canadian. We're not seeing it yet, but it's a nice little sideways range. If it finds support again at the 200, there's a decent chance it tries to bounce. So once again, looks like the U.S. dollar at some support. And finally, we have the U.S. versus the yen, and it's just been trading sideways. I think both of these are struggling to really figure out where they want to go next. But we are at support once again. If anyone is looking at this one, we've got a decent trend line here that coincides with an okay price level here. We could probably drop this to about there. So there's a chance that we get a breakout in the U.S. dollar versus the yen soon, and maybe you can get a good 100 or 200 pips here as it makes its way back up to the 200. So a possible trade developing here for anyone here that's into Forex. I know not a lot of you guys are, but it's good to keep an eye on the Forex just in case sometimes you get a move on this, maybe when the stock market's not cooperating. So overall, the U.S. dollar has been pretty weak, and I think that's reflected on what gold and silver are doing. You take a look at GLD. You can see that it had that really strong breakout. And as gold has started to, as the U.S. dollar started to trade sideways, we're seeing the same thing in GLD. However, this is still pretty bullish. It's just a bull flag. And for those that are looking for a new move in GLD, obviously you want to see a breakout past 170.50. But you want to see that with a breakdown in the U.S. dollar. I think it's important if you're long gold, and so Fat Boys, if you're asking me about gold, keep an eye on the U.S. dollar as well, as that could have an effect on this. I think overall GLD looks pretty strong, but there's a decent chance that if the U.S. dollar finally bounces, which it looks like it might, then this might come back and start testing its moving averages. GLD has a tendency to kind of trade in a wide, sloppy manner, as it usually doesn't have very tight consolidations like this. So keep an eye on it. Momentum traders, this is still offering a potential long-term trade, although, like I said, I'm not very keen on trading breakouts at highs. This isn't really the stock market, but a lot depends on what the U.S. dollar does. If you look at SLV, it's doing very similar. Very nice breakout and making its way upwards as well, all the way up to 18. And, again, just kind of reflecting the weakness that we've seen in the U.S. dollar. Now, if we look at gold, as far as Barrick gold is concerned, slightly different pattern, right? And some of this has to do with it being a stock, so of course it's going to follow the stock market. It's not going to just follow what what the underlying commodity does. So my question for you: what exactly is your goal here with Barrick? Are you looking to go long? I'm not that excited about going long here. And I'll show you. So basically, these are the trend lines that are important to watch, right? And so what we have here is we had an attempt, basically a triple top, right? 1, 2, 3 tries, and then failed, right? And then once we failed, we made our way right back down, and eventually found support down here around 22, which was the previous level that it was, the previous highs. And then it's made its way all the way back up, and then right away was rejected before it could even get to that level around 28.50. And now we've kind of lost this upwards trend, right? And we've come back, and again, we did find buying pretty quickly. However, if you look where we are right now, you can see that we've got this convergence here where we're having kind of some issues trying our way right back up. You're asking take some profit. If you're, it depends where you're long from. But if you've been long Barrick Gold for a while, this probably was a good spot to take some profit. Probably still is a good spot to take profit. Maybe not close out the entire trade. I don't know where you entered or how long you've been holding it. If this is a long-term holding or if this is a short-term holding. I think a lot depends on what exactly your overall aims are with this. We take a look at the weekly chart. I think weekly, so if this is a long-term holding, you're still fine. There's nothing to worry about long-term. Now, if it was a swing trade, and you got in at 24, so you got in here. So typically for me, if I'm taking a swing trade here, then I'm looking at taking profit at the top of the range. I think you followed enough of my trades. Okay, long term, so that's different. All right, because you followed enough of my trades to understand what my profit objectives are when I'm swing trading. Now, long-term trading is a different animal. And what you want to do in those scenarios is you want to buy at the bottom of ranges and you just want to hold. If you enter this long-term, you've only held it for a month, right? I don't think that this is a spot where you want to go ahead and take profits. If it's long-term, you just have to be happy with what it's doing and just kind of keep holding it, okay? Keep that in mind. Like one thing you have to understand is there's different mentalities when you're trading short-term versus long-term. When you're trading something long-term, you just want to find good entries that you trust and then just let it do its work. So that I'm a long-term holder of Tesla, right? And if I was worried about when it gets too extended, I would have gotten out of it a long time ago. I added a bunch of it in March. Obviously that's a great spot to enter. But it would have been easy to go ahead and try to get rid of some of it in the 700s, right? Heck, it would have been easy to maybe get rid of some of it up here in the 400s when it started to make its way back down. I could have maybe worried a bit when it started to sell off here at 800. I could have worried about it when it sold off at 9. I could have worried about it 2 days ago. But the fact is, it's a long-term holding. So I know that I don't have anything to worry about it. So I don't need to kind of deal with it at the moment. And it's the same thing with this. If you have your conviction that this is good long-term, then you don't want to worry about it just because you've held it for not even a month yet. Okay? Now, I do think it's going to struggle a lot with 28. But again, if you have a long-term view of gold and you think gold is going to continue upwards and the gold miners are going to follow it, then I think it's way too early to really worry about it right now. Now, that being said, I do think that if I was swing trading, I would have closed this trade out because I do think there's a pretty decent chance it's going to come back down and retest 24. Because again, just looking at what we're seeing right now, we had this break of the uptrend. Now, it could end up that it holds and follows the 20 and continues to make its way back up to 28. But there's also a pretty decent chance that it struggles here and needs to head a little bit lower before it finds support. However, like I said, you have different names when you're swing trading versus long-term trading. And the fact that this is a long-term trade means you kind of have to have some faith in what your entry point was and, just what your aims for the trade are in general. It's easy to get overly nervous and to micromanage trades. And you have to understand your time frames. If you're looking at a time frame of months or of years, then you kind of have to just buy it and kind of put it to the side and not even pay attention. One thing that I found helps, for those of you that are still here, is to separate your long-term trades from your short-term trades by, maybe even using different accounts. And you don't really, the long-term account, you don't need to look at it every day. You kind of manage things big picture, and you don't let the profit and loss affect you from day to day like you would with a swing trade. because again, you have different goals and different objectives, and you have to understand that you're going to have to weather some storms if you want to hold things for longer than a week or two, or longer than, I would say 3 months is kind of the key, because that's the earnings cycle. Once you make the decision that you're going to hold things through the earnings, you have to understand that there's going to be good and bad, but you have to realize that you're really investing in the long-term ascension of stocks, right? And not really worry about these short-term moves. So short-term, I'm not that excited about this, but I think long-term, if you like it, and you can see it's done well. So if it's going to continue, then you don't want to buy it here at 24. Now that being said, long-term, I might have waited a little bit more to scale in, but I might have missed out, right? So I'm not sure when you entered, but I tend to be very patient with my long-term entries, just to make sure that I don't get shaken out or have to worry about moves that go back and forth. But you can see the explosive move in GLD, particularly once the market really struggled. And I've seen some headwinds of people saying gold might be the next area. Like if we do get more selling pressure in the markets, then a lot of money might flow back into precious metals. All right, so I don't see anyone else with a chart request, so real quick, we'll look at, and Fat Boys, you were asking me about this one anyway, because this is one of our Patreon trades. So for those of you that are still here, and I always like to show you what I consider good risk-reward opportunities and what types of trades I'm looking at. So in my mind, this is what you would consider a good long entry, right? We have a stock that's sitting at support. It's trading in a very tight range, and when it breaks out, you're not looking for a breakout at highs. You're looking for a breakout down here in a tight range at support, so that your stop is really close, right? So in this particular case, my entry was actually Monday on the ugly candle, so I was a little bit nervous about it, but it was able to pay off on Tuesday, and then on Wednesday it finally had the breakout, or today obviously. But you'll notice it's like the entry's around 26. You have a stop out point that's not even a dollar away, and you have a profit target of about 4 points, and a scale out level of maybe 2 or 3 points, right? And so that's where we stand right now. This is why I was asking you. Oh, you're right. I didn't go over oil. We'll look at oil in a second. Thank you for reminding me. But this is another one you had questions on, right? So this is why I was telling you the scale out depends on what your entry was. If you entered today, then it doesn't really make sense to scale of a portion out of it today. But you can see today's kind of the top of it's kind of an intermediate range, right? You can see that there's a price point here, not just from the 30th of April, but even here around this level. This 27 to 28 is kind of an important range. So a lot of times I look to scale out of a piece of it so that I feel more comfortable about holding it. But you can see 29 to 30 is really the target. I don't think it's going to make its way through the 200 right away. So this is going to be a level that maybe it stalls out on the next day. But if we can get a move through that, then that'll be a really good, nice trade in hopefully just a couple of days' time. So if you got in yesterday, then today's a good spot to, like I said, maybe take a third of the trade off, and then or a half, and then hold the rest, looking for a move upwards. And maybe scale more out at the 200, and then maybe look for a move up into the 30s. And that would be the way it works out for us. And that would hopefully be a good move. Right, so like I said, that's for those of you that are interested. This is what the kind of trade ideas that we come up with on our Patreon. Last week we had INO that worked out well for us. It feels like every week we've had at least one trade that pays nice dividends for us and gives us a quick move up. I mean, this one gave us from 22 to 28 a nice 6-point move, and it's kind of come back, but it did give us a nice, decent return pretty quickly. And we, it seems like every week we get at least one of these. I know Fat Boys has been following me on a few of these, so hopefully it's made a difference in his account, and he's been able to book some nice profits over the last month or two since he started following. All right, so let's look at oil. Again, this is going to be hard until we get rid of this, but I think we're getting to a point where we can maybe still look at the daily chart. So here's what oil has done since March. Still looking nice. Struggling with 41 to 42, and I think that's an important price point. And really, that's going to be I think this is one of the areas that we could watch to really see how far the market is pricing in a full recovery. If oil starts to make its way back up into the mid 40s, like 45 or above, then we have to go under the assumption that the market is expecting more energy demand and more, resumption of a normal economy. So this is kind of critical where we are right now. Let's see whether we could break 41, 42 and make our way upwards. If we falter here, then we likely make our way back down, back to 40, and then possibly down to 34, 35. And then we'll see what happens from there. I think again, sometimes I like the 4 hour for this just to give us a little bit more candles to deal with. So we get the fluctuation a little bit better. But basically, this is what oil has been doing over the last couple of months, and as you can see, it's still pretty bullish. Now I guess at this point we could change this trend line and move it down to this area, right? And you still get this. We still have this trend that's developing here, and you can see we're struggling at 41.20, but we're slowly making our way upwards and challenging it over and over and over again. Sooner or later, we're either going to get a breakout or we're going to get a clear rejection of price, which will either lead again either to move up to the 42, 43 area or move back down into the 37 area and then possibly down to the 35 area. Not sure again where we stand yet with this. Obviously we have to wait for the price action to tell us. I think overall oil is in a pretty tight range right now, and it probably is better to wait for it to break one way or the other before we really get a clean trade coming on oil. For now, it's just trading. This is basically noise as it trades inside of a pattern. Okay? All right, so that covers it for today. For those of you that are in here, if you have a question that you didn't want to ask in public, you can always ask me on Twitter or email me, stockdarts@gmail.com. I'll be more than happy to answer your question that way. You can always find us on Discord and ask me on there, and I can send you whatever chart or let you know whatever my take is on whatever chart you're looking at, or whatever other question you might have regarding trading. Keep in mind, again, like I said before, we're in an earnings season, so if you're looking to trade a name, make sure you keep track of what the estimated date of earnings is, right? So, for instance, let's say you wanted to trade Netflix for whatever reason. Understand that Netflix, their earnings is on Thursday, right? So you really don't want to enter a trade right now unless you're actually taking a trade that takes earnings into account. You can see they're coming up here, July 16th, which is tomorrow. So unless you're actually someone that trades earnings, you don't really want to look at trying to trade them right now. You want to wait till after the earnings, because this is a name that can move 10 to 20% off of an earnings move. And you don't want that kind of extra volatility unless you're accounting for it on purpose. Okay, so every name that you look at, find a website that gives you earnings dates, and go ahead and use them. There's a couple good ones I like to use. One of them is this one, stocksearning.com. Another good one is Earnings Whispers. Either one of these, they're free. You don't have to pay anything to use them. They give you earnings calendars, and you can get a good idea of what's trading each day. And so like you can see today, Goldman Sachs was reporting. You've got USB, some banks and stuff, Alcoa. Tomorrow you'll have Bank of America, Johnson & Johnson, Domino's, which maybe would be interesting to see how the food industry is doing. And then, like I said, we'll have Netflix in the afternoon. So always go ahead and come to any of these. You can just type whatever ticker you're looking at. Say you want to trade Amazon. You can go to Amazon. It'll tell you where Amazon is trading. Right? So estimated July 30th. So now you know how much time you have to trade Amazon before they report earnings. So make sure whatever stock you're looking to trade, keep an eye on the earnings date, because that's going to introduce a lot of extra risk that you don't need if you're just trying to take an earnings move. And you might think to yourself, well, yeah, the earnings might help me out. You could, but earnings is a coin flip. And there are plenty of stocks that do well and run up into earnings only to turn around and pull back because the earnings was baked into the price. So you never want to kind of gamble on that unless, again, you're taking an earnings specific trade like I like to do during these earnings seasons. Okay, so better safe than sorry, like I always say. All right, guys. So again, that covers it for today. We'll meet again next Wednesday. So have a good rest of this week and weekend, unless you need to talk to me on Twitter or something. All right. Thanks.